Okay, good afternoon, everyone. Hope you are enjoying your trading today, Wednesday. Yeah, usually Wednesday um, we have a lot of setups, setting up. Yeah, because that's when you have weekly vessels. Yeah, but seeing how good yesterday was, I doubt if today will have a lot of setups. Will have, yes, but they won't be as much as yesterday. Okay, so I just want to show you the setup that I shared in the group, like how you would have approached it using the rules that I gave when I presented the Sunday lesson. Okay, so let me just share my screen. Okay, let me share my screen so that everyone can see. Okay, so I shared this setup. Uh, Let me just check the time that I posted that you should keep an eye on it. Just check the time. Hmm. Okay, so I shared it at exactly 10:59. That keep an eye on this pair. Yeah, so keep an eye on this pair. So I was referring to this setup, which is here. Let me pull PowerPoint beside me so that we see how we followed the rules, all the rules that we have. We see how we followed all the rules that we have. Okay, so as you can see on this chart, uh, focusing on the rules that I gave you, the strategy rules there. The first one says as price crossed above, oh, sorry, these are entry rules. Let me go to the confirmation rules so that we move in that order. Okay. Okay, so those are our confirmation rules, and I told you that you need to follow the rules for you to be consistent in trading. You know, trading is a dynamic uh, market. It will present you with a lot of options, a lot of things. So you need to filter out the most important things that you are considering in the market. You can't trade everything. You can't trade, no, there is area 12, what. So you have to make a structure out of the structureless market. Okay. So I gave you a format, a structure that you need to follow. Okay, so the confirmation rules for us to confirm that okay, what we are following is a valid setup. Okay, so you first check the news. I said you can check on the Forex Factory. You just go on Google, just type forexfactory.com. It will bring you the news, the calendar, and everything. So that's the first thing I do when I sit on my terminal. I check, is there important news? Is there news that is going to affect my trading day to day? If there is any, I note the time and avoid to finding myself trading on those times. Okay, then the next one is what is the direction of the H4 harmonic? Okay, so for you to check this, the direction of the H4 harmonic, remember uh, there's this indicator that is showing these stars. So those are harmonic stars. Okay, so before pressing any trade on a lower time frame, you first check or what the higher time frame is saying. Okay, so you check, you go on the H4. Okay, so I'll just do that. You go on the H4, and on the H4 time frame, you can see that this price, they are telling us that it has a potential of going low. It has a potential of selling rather than buying. Okay, so how do you know that? You can tell by this star harmonic that is there. It is a red harmonic telling you that, okay, this market is inclined to the downside of the market. Okay, so now after you check that, you go back to your 15 minutes time frame. You go back to your 15 minutes time frame. Okay, uh, you go back to your 15 minutes time frame. Then from there, let me pull out my okay. Okay, so then from there, what you do is you start again checking if everything has lined up in your trading rules. Okay, so we have seen that there is no important news. The 4-hour harmonic is showing that it is going down, and we are looking for an opportunity to do what? To sell. So meaning we are in line with the 4-hour harmonic. We are not countering, but we are in line with the 4-hour harmonic. Okay, so the third thing that you're going to ask yourself is the price supported? Okay, by supported, I don't mean those lines that you draw like support and resistance. You connect one price to the other price to see if it will break it or not. No, I mean specific lines on the chart, like the template I use, it has specific lines that I look for. So there is a BT, which simply means the brute tracer. Okay, so there is this dotted line here. You can see down here. This is the BT, the brute tracer. Okay, so what is the brute tracer? The brute tracer is just basically a line that shows the previous day low or the previous day high. So it will show you that the previously, like in this case, Monday, price traded up to this point. So that was the lowest point. And I'm sure there is a brute tracer up there, which is showing that price, that was the highest point of pricing during that day. Okay. So now there is also this, the quarter point. The quarter point is this dotted line also, which is yellowish in color. Okay, so quarter point is just 1,000 pips. 1,000 pips divided into four parts. Okay, four parts, meaning you are going to make it 4 quarter points, 250 each, separated at 250 each. We don't have to go deep in those concepts. You can just know that there is a brute tracer, there is a quarter point, there is also the 250 EMA. Okay, so on my chart, this blue line here, which is following price, that is my 50 EMA exponential moving average. Then the white line there, that is my 200 EMA. Then the red line here, this is my 13 EMA. What is my 13 EMA? Okay, so is price supported? So if you look at this price here, it is supported on the 200 EMA. Okay, so the 200 EMA is present there. You see? Okay. The next thing you are going to ask yourself is there a clear M or W? Now, on this point, if you can't see how clear the M or W is, the best thing you can do is just skip the setup and look for other opportunities. Yeah, but you have to create an eye of spotting these setups because they won't always be clear, but you have to know the variation to the theme, how they can present, how you can spot them. Okay, so if sometimes if you're having trouble seeing if this is a clear M or a clear W, what you can do just is to activate this line graph like that. So everything, all the candles will disappear, and what you have there will be just lines like this. So this is our focus point there. Okay, so you can see that there is a sort of an M there with a second leg short, the second leg which is shorter. Okay, um, so you can only be able to successfully identify these M's and W's if you take time to look at the charts. You see how they present, how different they can be, and all those things. Okay, so moving on, we can let me just change it back to candlesticks. Candlesticks. Okay. Candlesticks. Okay. Okay. So moving on, we can see that there's an M pattern there. Price came up. They closed below that candle there, closed below the 13 EMA. They went up again with this bullish candle. Then they came and closed below again the 13 EMA there. So this becomes your confirmed M like that. Okay. So there's a clear M pattern there. Okay. So now, do you have 1 on TDI? Okay. So these lines that are showing down here, this thing, the whole thing there, this thing which is down here, that is what we call TDI, Trader Dynamic Index. Okay, it's an indicator that has got a combination of a lot of things. Relative Strength Index, there is the Liquid 50, Static 50, and all those things. Okay, so what I mean by 1 on TDI, this uh, with point is that if you look at the the green line, this green line, the first leg here of the M, this is the first leg there like that, and that is your second leg there. So the first leg should push this green line out of the band like that. Okay, you can clearly see that it is out of the band. The bands that I'm talking about are these light blue lines. Okay, so it went out of the band there. That is one leg out of the band like that. Okay, and the second leg was formed one leg in the band. Okay, one that is called the 1-1. Okay, so that has confirmed also. So the next one that you're going to ask yourself is there a harmonic star on the first leg? Okay, so if you look at the first leg, you can clearly see that there is an harmonic star there. Okay, so meaning this setup, the entire setup is confirmed. Okay, so a confirmed setup doesn't mean you have to jump in there and then now you have to enter and start trading. You have to wait until it gives you the entry criteria. You have to wait until the entry criteria are met. Okay, so what are the entry criteria? So looking at the entry criteria that we looked at again last time is this. Okay, so you are going to start again. So has price closed above or below the catch up? In this example, we are looking for price to close it below the catch up because we want to sell. Okay, so price closed below the catch up. The catch up is the 13 EMA, the 13 EMA here. Price closed below the catch up. there. That is the point where price closed below the ketchup. Okay. One, it has confirmed. So as TDI crossed the market baseline. So the market baseline on TDI is this yellow line, the yellow line here, which is following. Okay. So MBL, meaning market baseline. So you are looking at this line, to cross the market baseline. So if you look at that point where price closed below, if you follow it down there, if you follow it nicely down there, okay, you can see that it wasn't crossing the market baseline there. Okay, you can see that it wasn't crossing the market baseline. Let me get this point so that it is here. So if you look at that point there, it wasn't crossing the market baseline down there. So that criteria wasn't met. Okay, the next thing you're going to ask yourself, the next thing you're going to ask yourself is, do you have a reversal pattern? So in this instance, you're looking for stars, you're looking for code of wood, railroad track, or a shift candle. Okay, so if you look at this pattern here, this three bar pattern there. Okay, when I first started teaching this, I mentioned that you have pattern like that. So that is an evening star there. An evening star is there, and it is enclosed in this shadow box there. Okay, so that one is valid. Okay, so is there 10 pips or more between the current price and the nearby EMA? Okay, so if you look at where price closed there to the next EMA, the nearby exponential moving average, can we have 10 pips there? Okay, so you just check whether you have 10 pips or more. So just get this arrow pointer there. Just put it there and drag it to the point. Okay, from there to there you can see the middle figure there. It is saying 46. Okay, so you ignore the last digit, so that is 4 pips. Okay, that is 4 pips from there to there. So we don't have for at least 10 pips to the next resistance level. So what we do, that one hasn't been met. It hasn't been met. Okay, so you will not enter here. Okay, because the entry criteria hasn't been met. So you wait until the entry criteria is met. Okay, so for those who maybe who ignored the entry criteria and everything, you entered there. The price closed above the ketchup. You better leave your trade there because you don't know whether this price will go up and challenge that level there. So whenever it closes above the ketchup, you leave the trade. Okay, so it closed above, it rolled back again. Here again, you are too close to this EMA. So the only time you're going to take this trade is until it breaks this line, and it nicely broke it with a shift there. It gave you a shift. Okay, with this shift candle there. Okay, so your only true entry in this trade would have been there just after the close of that shift candle there, or you wait a bit. Usually when they shift the zone, they usually pull back into the candle before they drop. Okay, you wait a bit and enter on a pullback there. Okay, so there are rules also when entering on a pullback, but if you don't want to wait and everything, you just enter your trade there. Okay, so now when you enter your trade there, listen, This is where a lot of people are so afraid, and when they have taken a trade, they are glued to the computer or the phone like that. When you enter a trade there is no guarantee that that trade is going to go your way. There is literally no guarantee. All you are doing is you have seen this happening, you have seen that this pattern repeats itself. So anything can happen in the market. Someone can decide to buy the market and it can go up with a fast candle. So for you to remove the emotions, of course, you cannot remove all the emotions in your trading because they are part of you. But for you to control your emotions, you have to trade in probabilities. So when you enter a trade there, you know that there is a probability that this trade I'm going to lose. And there is also a probability that this trade is going to go my way. Okay, so this strategy that I taught on Sunday, I told you that it has got 80% edge, meaning 80% of the time when you follow the rules, you're going to be right. Okay, so meaning when you enter there, you have a 20% chance of this trade not working out in your way. So what do I mean? When you enter your trade there and the trade goes against you, you have to know now how to minimize the losses. How to minimize the losses. Remember, before you enter a trade, you have to define your risk. One, you need to know when to get out of that trade when it has shown you things or when it has invalidated itself. Okay, so you need to know when to get out when it has invalidated itself, and you also need to know when to take your money because you are in this business for money. When you enter a trade, just because you are in a trade, it doesn't mean it's going to move 100 pips or 200 pips or so. It doesn't work like that. So you need to know when to get your money and when to accept small losses when it has not gone your way. Okay, like I told you on Sunday, it's very important for you to trade in sample size. Don't focus on one trade. No, this trade has to work. This trade has to work. No, it doesn't work like that. You'll be frustrated all the time because the market will always pull back and you always have emotions and you'll be scared, fearful, and all that. Okay, so uh, you enter from there. Okay, so what do you do? Remember on let me just wait a bit. Okay, wait up a bit. Okay, like this. So remember, uh, on Sunday, I told you that since you don't know what is going to happen next, you are going to put a protective stop. That stop is going to help you minimize uh, the losses that are going to come that you didn't foresee. Like maybe there's a news release you didn't consider, or maybe there are just some things that the market maker is trying to get. Maybe the market maker has seen that there is money up there. So when you enter your entry there, okay, you're going to put a protective stop. So usually I put my protective stop 20 pips away from my entry point, 20 pips away from my what entry point. So if I enter from there, my stop loss will be somewhere 20 pips away there. Now, it doesn't mean that price has to go and hit my stop loss for me to realize that I'm in a wrong trade. No. What do I mean? Even if I've placed a stop loss there, yes, and it's a good thing because it will protect me from unforeseen events, I'll still trail my trades. What do I mean by trailing my trade? I'll trail my trade not by setting a stop loss or a trading stop or anything like that, no, but I'll trail my trade using this red line. The catch up is what we call the catch up, the 13 moving average. Okay, so I'll enter here. So for as long as price is staying below this line, I'll still be in the trade, no matter how much the market is going to dance around, going to dance, I'll still be in the trade until I hit the take profit that I set. Until I hit the take profit that I set. Okay, so now looking at this, um, where will be my take profit? Like my first take profit in this trade. Remember, the way I trade me is I take money out of the market as the market makes it available to me. Okay, so I'll set my first take profit and my second take profit will be trading this line here. Okay, so again, remember my entry was there after that shift candle. So I'm going to ask myself, where is price going to find difficult to penetrate? So usually price finds difficult to penetrate on those things that I put there as support. Let me just pull up the PowerPoint so that you see. Okay. Uh, okay. This is it. So usually price will find it difficult to penetrate the blue tracer, the quarter point, the 250 MA, and the 250 MA. Okay, so I've said usually doesn't mean all the time it will find it difficult. Sometimes it will just penetrate as if it's a hot knife penetrating butter. Okay, so I'll enter here. My profit will be, look at these lines here now. So you have the yellow line, which is the quarter point. You have the blue tracer, and you have the blue line there, which is my blueberry. Okay, so from here to these lines here, that is where I'm going to take my first take profit. My first take profit. Okay, so before that I'll even measure, okay, how many pips is it from my entry point to my first take profit. Okay, so from your entry point there to your first resistance level, it is about 21 pips. Okay, you see that middle number there, 217. You ignore the last digit, that is 21 pips. Okay, which is a good number of pips to take, 21 pips. Okay, so that is where my first take profit will sit. Okay, and my second take profit will trail the what? The catch up, will trail the catch up. Okay, so now let's see how this one played out. Let's see how this one played out. Okay, so you can see that this one, it went and hit the blueberry down there. So after hitting the blueberry, what did the market do? The market reversed with a very big bullish candle. I think this candle was about 16 pips. So now, if you are trading with emotions, you don't know what to do. In this case, you don't have rules, you don't have anything. You are easily going to run away from this market because it has shown you something which is very scary. That candle will trigger emotions that you're going to give away whatever money you made. Remember, you entered from there. That is your entry point there. And your trade moved quite right down there. Then they started eating into your profit. So you are going to leave the trade and save whatever money you're going to have. But remember what I said. Remember what I said. I told you that so we are on trade management. Trade management. I told you that you need to what? Trail the stop, the catch up. Need to trail the catch up. Okay. So in this case, me, when price reached there at that level, I took my first take profit. So whatever this candle was presenting, fear or anything like that, I was already in profit and it was locked. Okay. So you now trail the what? The catch up. You see how this bullish candle went up, but it never closed above the 13 moving average. The second candle again, it was just dancing. They just pierced through the 13, but they never closed above the 13 there. Okay. And they started rolling back down. They started rolling back down. As you can see, they are still rolling back down. Okay. So if you are trading the catch up, again, one thing you should know is that know where price will have difficulties in penetrating. Okay, so price will have difficulties in penetrating the quarter point, the brute tracer. You also have the moving average. In this case, the moving average which is down is the 800 moving average. So it will have difficulties in penetrating those areas. As you can see here, it has just left a long pin down here. Okay, so now this doesn't mean that price will not penetrate this point. Again, it doesn't mean that price will penetrate it. No, remember what you are doing, you yourself, you're just trading the catch up. So when price moves, this catch up also move like that. When it moves, the ketchup also move like that. Okay. Then when this ketchup is moving, you should also be moving. Remember there was a protective stop there. You just move it maybe to somewhere there. When it moves again, you move it to your break-even level until it gives you whatever it gives you. Because when it reverses, of course, it's going to eat through your profit that you have made. Like it's going to make a reversal and close above like that, but you will still be in profit. You will still be in profit consistently. So that is what it takes to be a consistent trader. You need to follow strictly the rules. Without discipline or following these rules, they look very simple, but when it comes to implementing and following them, a lot of people usually find it difficult. So your entry there, you enter from there. Okay. Your first take profit there. There it didn't close above the catch up. You keep on and the current price is there. You see, so you have to understand that the price will never move in a straight line. It will never be like straight, like dropping. It will make those dances to scare you and everything. Okay, so this is the trade management part here. So put a protective stop that is risking only 1 to 5% of your account. Trail the trade using the catch up until it hits your take profit or close back above or below the catch up, close back up above the catch up. Okay, so you can just review this video for those who missed the Sunday lesson. I think you get something out of it, out of this. Yeah, I have decided to make this video because I want to limit my the lessons that I'll be doing like every Sunday to just like 1 hour. That's all, just 1 hour. That's all, so that I have other things to do also. Okay, so happy trading there, and remember, discipline and the consistency will keep you in the market for long. Okay.